Yeah, Nia can hear. She is. What about Arifa? Can you hear? Okay, so yesterday there was some couple of announcements made by RBI, right? Not RBI, rather there was one announcement by the government of India. If Chinese company want to go to the foreign direct investment in India, then they need to get an approval from Indian government before they actually go that route of doing the direct investment in India. So that was one of the major topic to talk about, and it was also there in the news, widely discussed by various news channels, and it was a hot topic for yesterday. What are your thoughts about the same? Is it good? Is it positive? Or is it not good? What do you think about this current new development which came into public domain yesterday, with the government of India stating that every kind of foreign direct investment coming from the Chinese company, that has to go through the government approval, and then it would be into those companies and the sectors which the Chinese companies are planning or aiming to invest into. So, what are your thoughts? How do you look at this development? And if do you have something different point of view, what the government of India thinks, and how do you look at this entire thing? Anyone for that
Sir,
matter? Yeah,
I
yeah.
didn't
Go
go
ahead.
by the news so far. I
Okay,
haven't
okay,
gone.
okay. Okay, okay. What about Ajay? Did you hear anything of this kind?
Sir, I just saw the tweets on Twitter about this news,
Okay.
so I've also not
Yeah,
gone thoroughly about it, but I just know that so the Chinese companies, if they want to now invest in India through FDI, so
yeah,
they need to get the approval from the government. So I think if this is the news, so it is good for the India and for the Indian
yeah.
companies also. And you know
Absolutely.
the Chinese what they did and through the coronavirus. So I think not only India, but I think other Australia, and I think there is one country, I think Europe. They've also
Hmm.
restricted China to
Hmm.
invest in their countries. So I think it will
Every
be a.
country,
I think.
every other
Hmm,
country is now trying to quarantine China from their own countries in
Yeah,
sort of every manner, because China
yeah,
has created this pandemic, and even the most prominent one is US.
yeah,
So
yeah.
US
Absolutely.
is keeping no calms with Chinese
Yeah.
government and even
Yes.
the WHO. So now every
Right.
country will look into this matter as a situation of its own country, and they'll
Uh-huh.
create a quarantine structure, quarantine situation for China.
Right. Right.
And
Absolutely. So this
it'll
is
be difficult for China to like cope up with the world economy now.
and I
yes.
think
Absolutely.
I think this is also important for countries also, because you know the GDP of their countries are going down. So to boost up
Yeah.
their domestic companies, this is the best option for others also to just
Yeah.
boost their companies right now, so that they can manufacture
Absolutely.
or you yeah this is
Right, right. Yeah, you both of you really raised very valid concerns and valid points. So one, it is also important for the Indian companies to have that level of support from the Indian government, that they do not just directly, or do not allow Chinese, or maybe for that matter the foreign direct investment into Indian market so easily, because that can definitely discourage or dishearten people who are in India or Indian investors, because this is the crisis time, and this is a time where Indian government should actually be supporting or encouraging the local and domestic investor. It's not a normal situation. It's an unprecedented situation wherein the coronavirus has really impacted just not India, but also the global economy. So it is the need of the hour that government should not be thinking as business usual. Business, it is not a business as usual, so it's a different situation altogether. So there should be some drastic measures which government of India should take, and in that regard, probably this step is not a setback for any of the economies, for that matter, China also. And things would be difficult for China going forward, because the way the China hidden lot of things about coronavirus, so that way it might not be that easy for China going forward in terms of doing their business in different countries. And if you look at China is strategically building its presence in global economies. It's a strategic plan. It's not something which is coming just by a chance. They are going with a strategic approach that they need to have, or they need to capture the global economies by as much as possible, so that they can actually command or dominate those economy in the long run properly. So that is the reason, if you look at their entire business model which they have followed until now, they have built a port, or they built a port in Sri Lanka, right? They also went in Pakistan in building some infrastructure project, right? So all these projects which they are actually building or making in other countries, there are some strategic vision behind those projects. It is just not because they are very keen to make other countries prosper and therefore they're going and making all those things. No, it is not like this. They really have big ambitions. They have global ambitions to strengthen their vision in terms of expanding their network, expanding their presence across the globe, so that they can actually command that sort of dominance which they actually thinking for quite long time. So that is the whole agenda. And this point in time, as we're discussing right now, if we allow China to expand in India like before, then probably it would be disheartening for people who are the local domestic supporters or domestic investors, given this is a time where the government really need to support them. And government is supporting them in a sense, because if you look at various measures which the government has taken so far, like curbing, not taking GST from the corporate and other financial players, so that shows the government is doing its bit. But slowly and gradually things gonna do or work in favor of those players who are there in India. So it's a long time, because things take time to build, but things don't take much time to collapse or demolish. So this crisis has actually showed the same thing. Things have really been been so worse at the ground level that it would take a lot of time to actually come up at the same level where the country was some time back. Similarly, it goes for other economies as well. If you look at the other ones like USA and the European countries, they are far worse hit than what India has been hit so far. So it is a right step in the right direction, which is I can feel, which I can feel at the moment. And finer nuances of the same decision would be known or would be revealed as we move on in future. Okay, guys. So this is something very important for all of us to be updated with the current situation which is going on, because when you would be in the office, or probably when you're doing the business with your colleagues or with your fellow team members, then you should be updated so that you can also pitch in and comment on these things. And now it is a time of media, and the newspaper is so, as in the information is so widely available on all the platforms, social media platform, Twitter and everything. So it is all the more important for every one of us to be updated with the current situation, so that we can chip in, and we can contribute in terms of our thought process. The thought process that we have, we can actually contribute with the help of that, to support or maybe not support, to disagree with. It's not necessary that you need to always agree with the point with the government of India is coming up, but you should have your own thought process, or you should have your own understanding about these things. Okay, so what about your Akriti and Jab? I guess these guys are not there. So are they still having training on Sunday or also? Any idea? Anyone has any clue? Apurv maybe?
No, sir, no.
No idea. Great. No problem.
I think sir maybe they are taking decision regarding the 20th
Uh-huh.
April tomorrow. So what they should do about the lockdown.
Okay. So, okay. So that is on a lighter note you are saying, right?
Because sir, I am also now Saxo Bank, so I don't have any training Saturday and Sunday.
So they are taking decision jointly with government of India, maybe probably April. Okay,
uh,
good.
yes, yes.
All right. All right, that's great. So, okay, so we will, okay, so I have made two more PPTs, right? One is about the vessel norm. So this is here we have, as in, we already talked about the vessel yesterday, right? So we'll not be covering it completely. Probably I'll just complete some part of it, and then because it would be repetitive, right? So then I'll share this with you. You can go through. This is the information which I was looking online. I found this really good in terms of the information it has. It really has a lot of detail in the entire presentation. So I thought probably you should also have this document with you. So as in whenever uh, you want to update your knowledge, so probably it would cover a lot of more things. So that way it may help you. And vessel is something which is always a hot topic. That is because it has a lot of information, and bank has to be compliant with vessel. So one has to be uh, clear with Bessel and everything. So this presentation would have, I guess, close to 30 or 25 pages. So Bessel norms, right? So when it came, it talks about the history. Historically, in 1970, the sudden failure of Bretton Woods. This is the one of the we talked about Hersted Bank, and this is one more bank that we were talking about. There were one more bank which failed in in the past or in the similar similar years or similar time. So 1970, when the sudden failure of Bretton Woods system resulted in the occurrence of casualties in 1970 as a withdrawal of banking license of many banks. On 26/97, German regulator forced the troubled bank Hersted into liquidation. That a number of international banks had released the payment of Deutsche Marks to Hersted in Frankfurt in exchange for US dollar that were to be delivered. So we have covered this. In 1975, 3 months after the closing of Franklin National Bank and other similar disruption, the central bank governor of G10 countries took the initiative to establish a committee on banking regulation and supervisory practices in order to address such issues. This committee was later renamed as Basel Committee on Banking Supervision. The committee acts as a forum where the regulators' cooperation between the member countries takes place regarding banking regulation and supervisory practices. Right. So this is the history. The committee aims at improving supervisory know-how and the quality of banking supervision quality worldwide. The purpose of supervision is to ensure that bank operates in a safe and sound manner, to ensure the bank hold capital reserves sufficient to support the risks that arise in their business, sound practices for banks risk management. The committee formulates guidelines and provides recommendation on banking regulation based on capital risk, market risk, operational risk. Though the BCBS Banking Committee of Banking Supervision, on Banking Supervision Committee itself does not have any superior authority over the government's central banks to which it makes recommendation, but its guidelines are broadly followed and well regarded in the international central banking and finance community. So if you look at this particular statement, so this statement basically talks about the banking committee or banking supervision. This committee which was formed as a result of many failures in the banking system during 70s 1970-74 time, And so this committee doesn't have authority, or they cannot make various central banks follow the rules or regulations which have been made or formulated by them. It is just a guideline for the central banks. Central banks are should be abiding by the guidelines which are which are made by these central banks put together in the form of BCBS. You can say so. These are the guidelines. So guidelines and regulation. The difference is you are just not bound to follow them. You can follow them, or you don't. You may not follow them. So that is as per the requirement and as per the discretion of the various government at their own level need to assess how soon or how better they can follow those guidelines, or if they're capable enough, if those guidelines are really viable to be functional, viable enough to be functional in that country or not. So these all calls has to be taken by the central banks of the respective countries only. So this is just a guideline. It's not something which is mandatory for all the central banks. In nutshell, is international framework for internationally active banks. So this is an international framework for internationally active banks. In a sense, you can say that this entire thing, the Basel norms, which we're talking about, it is an international framework. So why we say it's an international framework? Because economies are correlated, are interrelated. So if there is a shock which comes at one bank which is based out of maybe in Europe or US, then the aftershocks can be felt in some other economies as well, because the banks are interlinked. So that way it is necessary, like there should be an international cooperation. A bank should understand like these measures, and to strengthen each other is necessary, so that the links or the chain or domino effect doesn't become that big. And if there are control measures to ensure the things doesn't go wrong. So that is the overall objective. Okay, so this is again pre-Basel period. Is there we talk about the pre-Basel period from 65 to 81. There were about 8 bank failure or bankruptcies in the United States. Savings and loan crisis was one of the largest financial scandals in US history. Savings and loan crisis emerged in the late 70s and came to head in 1980s, finally ending in early 90s. Savings and lending deposits were insured by the Federal Savings and Loan Insurance Corporation. Depositors continued to put money into these risky institutions, but savings and lending engage in increasingly risky corrupt activities, including commercial real estate lending, investment in junk bonds, resulting in collapse of them. This led to insolvency of FSLIC, and the government bailout of thrifts to the tune of 124 billion in taxpayer dollars, and liquidation of 747 insolvent savings and lending by the US government. So this is just a background, or how this actually came into existence or establishment, how this Basel was established. So if you look at 65 to 81, 1965 to 81, there were a lot of bank failures and bankruptcies filed by various small to big banks. So savings and loan crisis was one of the largest financial scandals in the US history, right? So this happened in late 1970. The US government had to bail out 124 billion to save these consumers who had put in their hard-earned money into savings and savings in the form of deposits which they have given to the bank, and therefore they had to, as the government had to bail them out to save the depositors' money, and with that, this everything came into existence as the Basel came into action. The highly leveraged banks throughout the world were lending extensively, so much that the potential for bankruptcy of these major international banks grew as a result of low security capital. To prevent this risk, Basel Committee on Banking Supervision, comprised of central banks and supervisory authorities, 10 countries, met in 1987 in Basel, Switzerland. The committee drafted a first document to set up an international minimum amount of capital the bank should hold. This minimum is a percentage of total capital of bank, which is also called the minimum risk-based capital adequacy, right? Which we discussed yesterday, the same thing. So the general purpose of the accord was to strengthen the stability of international banking system, to set up a fair and consistent international banking system in order to decrease competitive inequality amongst international banks. In 1988, the committees introduced capital measurement system accord, which mainly focus on credit risk, minimum amount of capital the bank should hold. The committee by the end of 1992 that implemented the minimum requirement of ratio capital to be fixed at 8% of risk-weighted asset. The committee also issued market risk amendment to the capital accord in January 1996, which came into effect at the end of 1997. A concept of value at risk was introduced. The capital requirement was set on the basis of higher of the previous day's value at risk, or 3 times the average of daily value at a risk of preceding 60 business days. Right, so these concept value at risk also came into existence while looking at various risk in the system, by assessing how the risk vary each day, or taking an average of 60 business days value at risk thing. So this all things were factored in, and accordingly the risk weighted asset, which is 8%, was calculated. Basel I Accord attempted to create a cushion against the credit risk. The norm comprised the 4 pillars. The constituent of capital, is prescribed the nature of capital that is eligible to be treated as reserves. Capital is classified into tier 1, tier 2 capital. Accord requires tier 1 capital to constitute at least 50% of total base of banking institution. Pillar 2, risk weighting. Risk weighting creates a comprehensive system to provide weight to different categories of banks, assets and liabilities. Pillar 3, target standard ratio. Target standard ratio acts as a unifying factor between the two pillars. Universal standard wherein tier 1 and tier 2 capital should cover at least 8% of risk weighted banks of weighted assets of bank, with at least 4% being covered by tier 1 capital. Pillar 4, transitional and implementation arrangement. Transitional implementation arrangement sets different stages of implementation. So this is why I am just taking you through this again, because here the information is a bit more elaborative. So I will be sharing this thing with you. I'm just reading it through because we have already covered this part. So don't want to spend much time here. I would be just spending time where the portions of Basel which we haven't covered so far. So that piece I would be touching more, and this piece which we have already gone through, which we have already covered, I will just be skipping or maybe just reading it through fast so that it is covered, and at the same time we know that this is broadly covered yesterday. So this is again what is tier 1 capital consists of. Shareholder equity, declared reserves such as loan reserves set aside to cushion the future losses or for smoothing out income variation. What is tier 2? That is given here. Capital adequacy ratio, how that is calculated. Tier 1 capital, tier 2 capital, risk weighted assets, that is called capital adequacy ratio. Then transition to Basel II from Basel I. So now we are talking about Basel II. Basel II was fundamentally conceived as a result of two triggers: the banking crisis of 90s on the one hand, and criticism and limitation of Basel I itself on the limited differentiation of credit risk. There were just 4 broad risk weighting: 0%, 20%, 50%, and 100% based on the 8% minimum capital ratio. No capital, no recognition of term structure of credit risk. Capital charges are set at the same level regardless of maturity of credit exposure. Simplified calculation of future multi-country counterparty risk. Current capital requirements ignore the different level of risk associated with different currency and their macroeconomic risk. Lack of recognition of portfolio diversification effects. In reality, the sum of individual risk exposure is not the same as the risk reduction through portfolio diversification. static measure of default risk, assumption that a minimum 8% capital ratio is sufficient to protect banks from failure, does not take into account the changing nature of default risk and banking scenarios. So it is a bit more elaborative. You can say the things that we cover, it is the same thing, not different, not new things, but it is a bit more elaborative in a sense. So this you can see more or less the same thing, just a detailed and wording and statements are given there. I will here you can see those pillars again. These were the pillars that we talked yesterday also, right? Pillar 1, minimum capital requirement. Pillar 2, supervisory review process. Pillar 3 talks about the disclosure requirement for banks, transparency for market participants concerning the bank's risk position, scope of application, risk management, detailed information on own funds, enhanced comparability among banks. So all these things were there in pillar 2, oh sorry, in Basel 2, about 3 pillars. This is same, just the same diagram that we have here, that has been given with the approaches which were being taken under the credit risk, market rates, and operational risk. So those approaches have been given here. So if you look at this particular slide here, those approaches that we have discussed in this slide, they are detailed and mentioned, given in more detail here. So standardized approach, it directed bank to use rating from external credit rating agencies to compute capital requirements commensurate with the level of credit risk. There are 18 categories of individual assets specifically named the Basel II accord with risk weighting norms. So here, in terms of the credit risk, how how the bank should be assessing the credit risk for the various counterparties whom they have lended money, that should not be assessed by themselves. However, they should rely on the credit rating of the credit rating agencies which have given to those entities. And if the credit rating of those entities is the one which is not good in terms of the framework of in terms of the financial framework or the financial model, then probably the risk is more there. Therefore, the more money should be kept aside. The 8% that we talk about, the more of that should come from tier 1 capital, as we discussed yesterday also. So the more of that should come from tier 1, not from tier 2 capital, because tier 2 capital is not bank's capital. It is the borrowed capital which bank has borrowed from the depositors and the loan which they have issued to the investors. So that is how the tier 2 capital actually comes into account. So that is how standardized approach talks about. Then there is foundation internal rating based, gives bank the freedom to develop their own model to a certain risk weights for their assets. These, however, subject to the approval of banking regulator. Further, the regulators provide the model assumptions, loss given result, given default, exposure at default, and effective maturity. Banks are, however, allowed to use their own estimates of probability of defaults. So they, with this is an internal rating which was given. Again, it is again, if you look at this is FIRB. This is under the credit risk that we're talking about. So this is an internal rating which banks can also devise a system or design a system which can help them assess the risk with the various entities. And but this assessment which they would be doing would be subject to the banking regulator approval. If banking regulator approve that the assessment which the banks are making, probably that can also be one of the rating criteria or the internal rating criteria which can be used by the banks to their advantage, or you can say to safeguard their risk areas, you can say. Then there is another, that is advanced internal rating based, this one, that is AIRB. It is fundamentally the same as foundation IRB. except the banks are free to use their own assumptions of in the model they develop. Understanding this approach can be used only by select banks or those. So this is a bit more here a bit more freedom was given to the banks, and they were even allowed to use their own models in assuming the risk which they have with various counterparts or the various entity to whom they have loaned the money. And but this was selective to a set of banks. This was not given to all the banks. It was only selective to some set of banks. So this is again, so we already covered this part. You remember the credit risk, market risk, or operating risk? This part we already covered yesterday also. Only thing that we are covering right now is this approaches which were detailed, which were not detailed in yesterday's topic that we were doing. So here, if somebody actually asks you what different happened in Basel 2, so you can just elaborate the approaches which were taken under the credit risk and accordingly in market risk. So this PPT which you would be having with you, I will be sharing this PPT with you so that you can actually go through the information available here, and accordingly you can substantiate the points that you have known so far in Basel by learning the Basel norms and everything. So it would be more helpful for you. So similarly in the here we have market risk. Similarly, the approaches that we were talking about, which is also given here for operational risk, and it is also given for capital market risk. I'm not spending much time. Then we can just discuss bit of a what is value at risk. Value at risk is the most probable loss that we may incur in normal market condition over a given period due to the volatility of a factor, exchange rates, interest rates, or commodity prices, right? So this is a probable loss. So this is a model, or this is one of the system, or you can say this is a risk assessment tool that is used by the banks to assess a risk in a span of time, looking at the various market conditions. So that is called value at risk, and it actually calculates a probable loss which bank may incur over the span of time. So that is what the value at risk actually calculates. And value at risk is one of the widely used tool which is used in the financial market to know or to have a fair assessment about the risk in the financial system. So probability of loss is expressed as percentage value at risk at 95% confidence level implies a 5% probability of incurring the loss. So if somebody says the value at risk 95% confidence, that implies there's a 5% probability of incurring loss. So 90% confidence means there is 90% chances that there is no loss, and 5% chances there would be some losses, and the figures would also be given. Probably there we have an example. We can look at this example also. At 99% confidence level, VAR implies 1% probability of stated loss. Loss is generally stated in absolute amounts for a given transaction value or a value of an investment portfolio. One second. Okay. So if you look at this, loss is generally stated in absolute amounts for a given transaction value. So when you say this thing, it actually means there would be certain transactions or certain information would be given to you, and you would be calculating your loss basis those transactions, basis those information. So you would be having a set of information, set of numbers given for a year, maybe for 6 months, maybe for a month, maybe for 2 months.
So basis those numbers, you would be assessing what level of risk you may encounter further in future. So at large, we can say it is not a tool. It is not any such device which can really help you reduce, or it can absolutely confirm you that the 5% loss would be there in the near future. It is not like that. Neither it can guarantee you if some valued risk calculation says the 99% confidence level is such, so that implies indirectly you gonna have only 1% loss in the next 1 month, in the next 6 months, or in the next year or so. But that 1% which is being implied with the help of VAR, we need to first understand it is just coming with the historical data or the historical information which a bank has. So that information can be the current information of the bank, and that information might be the market information. So whichever way you can take it, so it may be possible the bank is taking the market information which is available in the public domain, or it might be the historical data which bank takes as per the losses which the bank incurred in the history. So it is not a foolproof formula, it's not a foolproof tool which can really ensure there would be no losses in future, or there would be only that level of losses which the formula talks about. It is just a measure, it is just one calculation which is basis the historical information available, and it gives a bit of a comfort level to the bank, like this is the level of a risk, so that they can be prepared enough to make more controls around this similar kind of a situation to mitigate the risk. This is overall the thing the valued risk talks about. So if we look at this thing, the valued risk is an estimate of potential loss always for a given period, which is that we talked about, at a given confidence level. For example, a value of risk 5p in USD INR rate for 30-day at 95% confidence level means the rupee is likely to lose 5p in exchange value, with 5% probability that in another 5p 5% in USD INR rate for 30-day period at 95% confidence level means the rupee is likely to lose 5p in exchange value with 5% probability, or in other words, rupee is likely to depreciate by maximum 5p 5% on 1.5 days of the period of 30 multiplied by 5%. A valued risk of 1 lakh at 19% confidence level for 1 week for an investment portfolio of rupees portfolio of 10, and this is 10, how much this is, 100,000 lakh 10 crore, 1 crore. 1 crore similarly means that the market value of portfolio is most likely to drop by maximum of 1 lakh with 1% probability over 1 week. So can you see this? This will give you a bit more. This would be a bit more clearer view. If you look at this value at risk of rupees 1 lakh at 99% confidence level for 1 week for an investment portfolio of 1 crore, similarly means that market value of a portfolio is most likely to drop by maximum 1 lakh. So if you have a portfolio of 1 crore, and if there is a calculation basis the data that is available to the risk manager, and if the risk manager comes so with this calculation that there is a 99% confidence level that the risk for a week would not be more than 1 lakh, would not be 1 lakh. So that basically implies there's a probability of 1 lakh risk. There is a probability of 1% probability of 1 lakh risk in a week's time. So that will be, so you can look at two ways. 99% confidence, the loss wouldn't be more than 1 lakh. 99% confidence, the loss wouldn't be more than 1 lakh, but the 1% confidence is this: the loss would be 1 lakh or less, right? But 1% probability is loss would be 1 lakh or less. So that there are two ways of looking at value at risk. So when you say 99% confidence, the loss wouldn't be more than 1 lakh. That means the loss would be less than 1 lakh, and 1% confidence, the loss would be 1 lakh or less. So that is how the things at value at risk actually looked at. Any question, guys, as of now?
No, sir.
Okay. Okay, so I'll not be doing, as I said, like I will not be covering all of these slides. Only would be touching the ones which I think need to be. Okay, so I'll just skip this one. This is again about the Basel II supervisory review process, market discipline that we have done. So I'll just read it through maybe for the information. It focuses on the aspect of regulator bank interaction, supervisory review. Specifically, it empowers the regulator in matters of supervision and dissolution of banks. Or, for instance, regulators may supervise internal risk evaluation mechanism outlined in Pillar 1, change them to more conservative or similar ones as the case demands. Regulators are permitted to create a buffer capital requirement over and above the minimum capital requirement as per the Pillar 1. Pillar 3, market discipline. It aims to reduce the discipline between the banking sector of the country. Basel II suggested a disclosure of banks' capital and risk profiles, which was shared solely with the regulators till this point, should be made public. So you can see this point. So when you say the market discipline that we were talking yesterday also, so this is more from the point of the investors or the customers' point of view, because the information was shared with the regulators earlier, but the regulator also said disclose your information to your stakeholders also, disclose it to your customers also, disclose this information with their counterparts also whom you're dealing with on a daily basis, so they also know about your risk profile, and accordingly they can make a decision if they want to deal with you or if they don't want to deal with you. So that is more of a disclosure. Market discipline basically is more of the transparency that we're talking about, more of a disclosure thing that we're talking about, that was factored in market discipline. So there can be more balanced approach in the whole financial sector by all the financial participants there, in the form of banks and NBFC or public sector bank. All of them put together can follow the market discipline. More disclosures can be shared with their customers, with the counterparts, so that things are clear by looking at the bank itself. So risk profile which was shared solely with the regulator till this point should be made public. The premise was that information to shareholders could be widely disseminated. They would be available to ensure prudence in the risk levels of the bank. Okay, then transition to Basel III. So Basel III also we touched upon yesterday. So it is again the extension of the same thing that we did yesterday. It has got some more information as we discussed. Basel Committee declared the committee's recommendation were for G10 member states. This leaves out emerging economies and actually implied potential unfavorable impact on these economies. Scope of responsibility for regulators may be too much for them to handle. Central banks might not be stringent enough in regulating private banks, thus letting them raise their risk exposure, defeating the entire purpose. Banks in emerging economies were at a disadvantage in terms of receiving loans from global banks. The consequence here was that global banks would need to maintain more capital for a loan to an emerging market bank on recommendation of external credit rating agencies. Basis assumption were pre-cyclical process, thus it failed to consider capital requirement during the inflation deflation of economy. Depends on good underlying data, complex to implement for emerging banking system, and enhance required skilled supervision and high depend on external credit rating agencies. So these were some of the findings which were came as a talking point in Basel III. So they were a bit of bit of at disadvantage, bit of not making sense to some of the banks in the global financial market. So they raised these points to the BCPS committee, and there they widely talked these points, like how we should be having more uh, more uh, more resolution or more solution to such problems. So in different situation, in different circumstances, they laid out factors, laid out laid out guidelines might not be that prudent to follow. So how banks should be going about following the right things at the right time? So that is what talked into Basel 3. And if you look at this slide, so some of the economies were disadvantaged because they realized, or even in fact the private bank will also be stressed, given they were supposed to manage a higher liquidity with the coming of Basel 2. So there was a probability they would be at a disadvantage because they would not be able to give uh, give the same amount of loans which they were able to do at one point in time in the past. So it was a lot of a discussion in Basel 3. It factored in, one, how the banks would be dealing when there is more crisis, when there is more risk. So as we discussed yesterday, counter cyclical, and then the leverage ratio. So all these things were also talked about in Basel 3, and those were factored in here. So these would be here as well in this slide, in this presentation also. So if you look at this one, the financial crisis of 2007 and 2008 exposed the limitation of Basel II, wherein certain risks were not under the purview of this regulation, augmenting the valued risk-based trading book framework with the additional charge for risk capital, including mitigation risk and default risk. Addition of stressed value at risk condition. This condition takes into account the probability of significant loss over a period of 1 year. So there is one term that is very commonly used in banking domain nowadays, that is called stress testing. So stress testing, on the similar lines, this statement is written here: addition of stressed value at risk condition. So stress testing is a testing which is a man-made testing which creates a situation. It's a human-made testing environment. So you create a situation, a stressed situation. How would you be able to cope up for a month, for a certain days when such a scenario comes up? So that is a testing which a bank has to do to review the controls which banks has and how effectively those controls can actually be playing when this kind of situation actually evolve in the financial market. So that is again factored in with the help of value at risk condition, and then bank need to justify that how they are really prepared to face or to encounter such challenges which may be eminent in the near future. Okay. So then in Basel 3, these were the 2 points which were talked quite widely, quite strongly. The essence of Basel 3 evolves around two set of compliance: capital and liquidity. So liquidity, because capital was there in Basel 2 also, and the liquidity was not that much that widely talked about. So liquidity has been, and liquidity, when you look at liquidity as a word, it has lot of many dimensions to it. So liquidity, one needs to really look at in various other in look at from very different dimensions. So liquidity is just not about managing a certain amount of fund at one. It's just not about managing a separate fund or separate pool of fund which can take care of crisis, which can take care of the risk and everything. It basically means when you are leveraging your position, how can you manage liquidity at the same time? When I say leveraging your position, that basically means you as a bank, put in your money into various other investment products. So when you are putting that money or that fund in those risky financial products, so would you also be manage liquidity that point in time when a hardship or when a difficult situation arises for the bank? So will bank would be able to pull out money so easily from those products or those investments where the bank has put in or infused their money into for the purpose of diversification, for the purpose of growth, for the purpose of good returns for themselves, for the investors. So all these things are factored into liquidity thing. So liquidity, which one point in time in Basel II was just related to having a separate pool of fund which can take care of a risk factor, but the risk, there could be many more risks. So liquidity was one of the risks wherein it was said like even the bank, when they're putting 8% amount at side as a risk of the risk weighted asset, so will that really be enough? Will that really be enough? So that was the point that was very widely talked about in Basel III. So so decision was made, if the bank is actually doing a lot of leverage, if they're giving a lot of debt, if they're having a lot of debt, and so then they might be having a 6% minimum of the tier 1 capital aside, rather than 4% which was discussed in Basel II. So that was one thing, and then there was another additional buffer of 2.5% if they are heavily using risky products for their capital return, for growth or for other things, then they also need to have an additional surplus of 2.5% kept aside to take care of those risks also. So these kind of things were discussed in Basel III. So that all goes into the liquidity only. Will the bank would be able to fulfill the liquidity that point in time? So this assessment was made in Basel III. So while I read this through, while good quality of capital will ensure stable long-term sustenance, compliance with liquidity covers will increase ability to withstand short-term economic and financial stress. Liquidity rules, one of the objectives of Basel III Accord is to strengthen the liquidity profile of the banking industry. This is because despite having adequate capital levels, banks still experience difficulties in the recent financial crisis. Hence, two standards of liquidity were introduced. So these are the two standards which were talked about in Basel III. Then this is something that we need to talk about, and then probably this is just for the information, key points for Indian scenario, and then probably we are done with this Basel thing. Okay, coming to the slide that we were. So these 2 points were talked in Basel III, and which really has a lot of meaning attached to it. Because there are many global banks who are really involved into lot of trading, lot of risky financial activities. So those financial activities need to be factored in, and in accordance to those riskiness or those assessment, bank need to have a fair amount of liquidity in their institutions. So capital conservation buffer, the intention behind is to make certain that banks accumulate capital buffers in times of low financial stress. When the buffer is utilized, banks need to recreate it by pruning their discretionary distribution of earnings. Banks facing reduced capital buffers must certainly not signal their financial strength by way of distributing earnings. Thus, the accord reinforces the constraints in distribution of earnings. The Basel III prescribed buffer of 2.5% above the minimum capital requirement. This buffer is built out of common equity tier 1. So only after 6% tier 1 and 8% total capital requirement have been fulfilled. So see, look at this thing. What we are talking about. We're talking about. So the 2.5% buffer, that was capital conservation buffer we are talking about. That is based on the kind of a risk. That is based on what kind of a risk bank is taking with counterpart, with the entities, with the various investors or various customers bank is dealing with. So if the risk level is really higher, then bank should also be keeping a 2.5% above the minimum capital requirement. And another line, if you read it, this line is primarily this till here. So it says the 6%, the first requirement is to meet the 6% from tier 1, right? And second is in total it should not be less than 8%. And over and above, then the 2.5% comes into the picture. Okay. Now, the counter-cyclical buffer, the underlying premise of the counter-cyclical buffer is that capital requirements in the banking sector must take into consideration that macroeconomic environment in which banks operate. Banks must arm themselves with the capital buffer in times of rapidly growing financial stress. It will be enacted by the national authorities when they believe that excess credit growth potentially implies a threat to financial distress. It will be enacted by the financial national authorities when they believe the excess credit growth potentially implies a great threat of financial distress. The buffer for internationally active banks is compared as a weighted average of buffers for all jurisdictions where the bank bears a credit exposure. Bank would subject to be a counter-cyclical buffer between 0 to 2.5% of the total risk-weighted asset. So see, so this is again for the banks who are doing the international, who have an international arms. So this was primarily for those banks who actually had international arms. So they also need to look at the macroeconomic factors. So basis those factors, they need to strengthen and build more measures to cater, to build more measures to take care of the risk which they can foresee in the near future due to due to the presence at the global level and at the international level. So there could be more risk attached to their overall system, because they have just not limited to in one financial market, but rather they are present in various other geographies or in various other global financial markets. Therefore, they need to have more liquidity in terms of mitigating the risk which is attached to their system. And therefore, this counter-cyclical buffer is primarily for those financial institutions who have got their international arms, and they therefore need to look at the macroeconomic factors, and accordingly the kind of a risk assessment which a bank does or the regulators tell them or the credit ratings tell them, they might require to keep an additional buffer of 0 to 2.5%. So in between this range, they would require to keep an additional amount above, other than what has been said here in the capital reservation buffer. This is something, this is the various level of risk which bank is taking. If the bank is not taking any risk, then the Basel II, which prescribes the 8% risk, 8% capital which they need to maintain, 4% from tier 1, 4% from tier 2, would be adequate enough to take care of the risk which a bank has. However, if banks is doing excessive trading, which is into derivatives and everything, then they would require to keep more of tier 1 capital. That could be 6% of the capital could be from tier 1. And if they have really a lot of a credit exposure to the entities and their leveraging, the leverage ratio is really bad, so that they have more debt. They have more debt on them. The banks also take debt, right? So if they have more debt with them, so then in that case they do require to have a 2.5% as the additional conservation buffer which they will be keeping aside to meet the risk which they have in the system. Similarly, the counter-cyclical buffer is also one additional buffer which could range between 0 to 2.5 in case they are having a global presence and the macroeconomic factor which they need to be factored into while they are calculating the entire risk assessment. So that is how these two things actually came into picture. Any question, guys, as of now? Maybe anything that comes to your mind you want to discuss or you want to talk about?
No, sir.
Okay.
Maybe we'll just go through these slides once again
Yeah.
during the week. So
Yes, that would be, yeah. So this is really something good stuff here, because I also found it online, right? And I really found it really good in terms of, while we are doing vessel, we should also be doing this, and it really has bit of a technical thing. So you might require two readings at least. Two readings you would need to it. So one reading would not be enough, because by looking at this at the one at in the first place, it would look quite technical stuff, but it would not be that technical, because we have already doing it we're discussing it. So you would not be finding, if you make two reading, it would be easy to understand. Okay, let's move on. Okay, so this is here we talking about okay, so we were talking about two things yesterday. One is liquidity coverage ratio, and then there is a net stability funding ratio. So what is liquidity coverage ratio? Liquidity coverage was introduced with the objective of promoting efficacy of short-term liquidity risk profile of the banks. This is ensured by making sufficient investment in short-term, high-quality liquid asset, which can be quickly and easily converted into cash, such that its financial institution to withstand sustained financial stress for 30 days period. So the objective of liquidity coverage ratio is to ensure the bank can sustain or withstand any risk in the period of 30 days. So how the bank is investing, what is the bank's liquidity coverage ratio for the 30 days? That is what is calculated by using, or by having this liquidity coverage ratio formula, you can say. So you see, if you see this thing, LCR is what LCR actually mean. LCR stands for stock of high quality liquid assets, then the total net cash outflows over the next 30 calendar days. It should be greater than 100%. It should be either equal to or greater than 100%, not less than 100%. So quality of high quality where the bank is investing, right? If bank is investing in stock of high quality, right, and if it is higher than the 100%, because when you invest in stock, in the blue chip stocks, right, so the liquidity of those stocks is also quite good, and returns in terms of it is always be better. So if this LCR ratio is better, then the liquidity that we are talking about to have an additional buffer of 2.5% probably would not be required. So this is basically to take care of the requirement in the short term. Short term means 30 days period. How you are actually you're going to manage your liquidity in the financial system. That is basically is coming out with LCR that we're talking about here, right? So banks, as we discussed in the previous slide, banks do invest in a lot of various products available in the financial market, stocks and everything. So stocks of high quality liquid assets. So if they're investing in there and they can really pull out money from them, so that means the LCR ratio is quite good for bank. If that is the case, probably the bank would not require to shell out higher buffers, capital buffer, which we are talking about in Basel 3, right? Similarly, when we look at the net stable funding ratio, what is the net stable funding ratio? It incentivizes banks to obtain financing through net stable sources on an ongoing basis. These standard require the minimum quantum stable and risk less liabilities are utilized to acquire long-term assets. The objective is to deter reliance on short-term means of finance, especially during the favorable market period. The NSFR has a time horizon of 1 year. So again, it is basically about the financing, how the bank is financing. It is to show, if, because liabilities, if bank is having a lot of liabilities which cannot be fulfilled in a span of 1 year, then it is basically the bank is carrying more risk in the system. So net stable funding ratio is incentivize banks to obtain financing through stable sources on an ongoing basis. So they really need to finance from a stable sources, so that the amount of available stable funding and the required amount of stable funding is always greater than 100%. If this is greater than 100%, then the stability is more in terms of the system. If they have financed if bank has financed money from a source, right, and that source itself is crippled, or that source is not able to sustain for a year, that funding is not considered to be stable funding. So that is how this net stable funding ratio is actually calculated. It requires the quantum stable and risk less liabilities are utilized to acquire long-term assets. So that is the two factors, so two things that we were talking in Basel 3, and that is also one of the important things. Then liquidity leverage ratio is same that we also discussed in yesterday's discussion or yesterday's presentation. So if you look at this slide, this basically talks about the critical characteristic of 2007 and 8 financial crisis was the overuse of on and off balance sheet leverage in the banking sector. Banks portrayed healthy risk-based capital ratio. However, the banks had no choice but to reduce the leverage in the worst part of the crisis. A vicious circle was created. Leverage ratio was incorporated in order to have non-risk-based metric in addition to risk-based capital requirement in place. The primary intention was thus to control the tendency of excess leverage and strengthen risk-based requirement. So since the implementation of Basel 3 involves significant changes in capital structure, the same shall be implemented in a phase-wise manner till 2019. So leverage is basically total exposure. If you see this formula, the tier 1 capital and the total exposure. Total exposure means total debt which you have taken, total debt which the bank has taken. So if that is would be higher than this percentage, that is the leverage percentage, as in would be higher, right? So if this is rather, if it is this total exposure is less, then it would be higher than 3%, rather I'll say. If this total exposure is less, this would be higher than 3%. And if it is less, if it is higher than 3%, it is bad for the it is good for the bank, not bad, it is good for the bank. And if this is less, then this is bad for the bank in a sense. So accordingly, the bank has to shell out more money from tier 1 capital if the exposure is more, if the risk is more, if the credit risk which the bank has taken is more, the tier 1 capital would be more for the capital adequacy risk that you're talking about, the risk with the CAR that we are talking about. So that would be more from the tier 1 capital. Okay, so in Basel 2, we talked about what all changed compared to the Basel 2 and 3. So minimum ratio common equity to RW. So this is something just for the information. We will not be doing any kind of so whatever we discussed so far in the previous slide, it is just given in the presentation in kind of a tabular format, so that you can see the differences. Leverage ratio, there was no, in Basel there was 3%. Counter cyclical buffer, there was nothing, but in Basel 3 it was included. So minimum liquidity when it came into existence, this is all talked about here. Systematically important financial institution, this is also something that we will be talking in the presentation. Okay, so this is the last from the Indian scenario. The implementation of Basel 3 norms commenced in India from April 1, 2013 in a phased manner, with the full compliance initially targeted to be achieved by March 31, 2018, but extended to March 31, 2019. So this is how it went. It was supposed to be achieved by 31st March 2019, but still it has further extended up till 2022 because it has not been even implemented at present. And given the various things, the bank need to maintain enough liquidity at the bank level, so that liquidity is really becoming a challenge, because that will come partially from the government support and partially the bank will have to maintain that, will have to manage that liquidity on their own. So that is why it has not been done as of now. It is a lot of constraints and challenges are coming, and it has further extended to year 2022. The Reserve Bank of India specified a Tier 1 leverage ratio of 2.5% during the parallel run period, as against the Basel Committee's Tier 1 leverage ratio of 3%. So whatever there is in Basel 1, so the Reserve Bank is actually making it more regulated and further strengthening it, further tightening it, you could say. So whatever is given in the Basel, Reserve Bank is just making a bit ahead of what is in Basel 3, so that it is more robust, more controlled. And this freedom was given in the Basel. Various central bank can decide basis basis their own financial sector or banking sector, how they perceive the risk and everything. So they can even heighten the ratios or the things which are prescribed in Basel norms, or they can also reduce them, looking at the risk and the factors which are prevalent in the financial system in their respective countries. So central banks accordingly can heighten, can lower those numbers which are prescribed in Basel norms. The biggest concern for the financial sector is growing the volume of the restructured assets and non-performing assets. The framework for revitalizing distressed asset has been implemented in economy, which has come to effect from April 2014. RBI prescribes a minimum capital to risk-based asset ratio at 9%. So in the Basel III Accord, it is 8%. However, RBI has prescribed 9% for as the minimum as the minimum capital requirement for the risk-weighted asset would be 9%, not 8%, which is given in Basel. According to CARE's estimate, total equity capital requirement for Indian banks till March 2019 is likely to be range of 70,000 crores, assuming that the average GDP growth will be 6% and average credit growth will be in the range of 15% to 16% over the next 5 years. So that is the estimate how much bank would require to shell out to manage the liquidity. 70,000 crores is likely which the bank would require to manage this kind of a liquidity that which we're talking about. And rather the 70,000 crore would just be from the bank side, and the one that we're talking about the government would infuse, that is not factored in here. So the total liquidity or total additional money which banks would require to manage a liquidity of 9% would be close to 2 lakh crore. 2 lakh crore is the total amount is estimated which a bank would require to manage to maintain a liquidity of 9%. So when I say 9%, that is the capital adequacy ratio we're talking about. So which is there in Basel 3, it is 8%, but RBI has prescribed 9% for Indian banks. So that is close to 2 lakh crore is the total amount which banks would have to manage on their own. So some part of it would be managed on their own, and some part of it would be managed with the help of the government. They would be using that money to bring them at the 9% requirement which RBI is prescribing for all the banking industry. So this is going to be implemented not so soon, maybe in another 2 years time. Given this entire situation now, I'm not sure whether it would really be possible for banks to implement this by 2022, or it may further be extended. You never know whether it be expanded, because this is a guideline. This is not something which the central bank or every country has to follow in letter and spirit by the day or from the time it has been prescribed. No, it is not like this. It is just a guideline which every central bank prescribes for the banking institution in their respective countries, and it can be followed when only the countries are ready to follow them. So it may further be extended. You never know, because 2 years time is not a very far off, and given the whole situation, current situation, so it looks to be a bit difficult for the banks. But how it pans out is something to look at, and we would be getting to know how things are actually turning out to be sooner than later. So that's it for the time being. Okay, so with this we complete the Basel thing. Basel is one of the important norms which everyone has to be very thorough with. And this presentation that we have done today really has a very it has a very descriptive, it is a very descriptive one. A lot of information is there. Maybe you require to read it through twice to understand them, or maybe you also require to see some of the information again or refer again with the help of Google or some other thing. If certain terms might be looking difficult to understand in the beginning, but it would be easy. If you give a 2 rating, it would be easy. It would not be difficult. So with this, I pause here and we'll say we can take 5 minute break. So we can resume at 10:30. I guess this is okay, right?
Okay, sir.
Okay, okay. Bye. Hi everyone. Hi all. All there?
Yes, sir.
Okay. Okay, so guys, now this is a good time, as in terms of you guys to start having your trading account also, because now you guys, as in people who have Apu, Ajay, so you can also start having some of the exposure of the trading and everything if you want to. I'm not sure, like you can open up account in your name, because there are certain policies which bank has. So everyone would not be allowed to open up a trading account. So you can just check at the bank level, and maybe you can open up account in the name of some relative or something, so that you can have an exposure. Okay, so I guess Ajay, you already open up your account with Kotak, right?
No, sir, I am not open. My brother have opened it.
Okay. So, if any help you need require regarding trading, regarding put, because maybe we can have another session that is dedicated to some of the strategies that we have regarding the the option strategies and everything, that we can talk maybe sometime later, not right now. So those strategies can really help you while you're doing the trading. You need to look at those strategies, and you can really do a lot of options trading also. So any help if you require regarding the trading account and all, you can let me know, because I have I have a friend close to me, or maybe one who already opened my account. Right?
Okay, so
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 you
so yeah.
yeah.
So what will be your brokerage?
Mine, in my case, it is quite less. So because he has got it approved for me, so that is 1 paisa is for the intraday, right? 1 paisa, and for your delivery, it is 10 paisa.
Okay, and what is your commission, sir?
Commission as in brokerage.
या कमीशन एज यू आपने अभी 3 बच्चों को सेक्सो में मतलब 2 को तो लगा दिया, तो फिर उसका कमीशन तो मिला नहीं, इसका तो मिल जाएगा।
नहीं, इसमें ऐसा भी कमीशन नहीं है। कमीशन जिसका होगा वो नहीं, क्योंकि जो ओपन करेगा उसका कुछ होता होगा, दैट इज अ डिफरेंट स्टोरी, बिकॉज यू नो जो काम कर रहा है रेगुलर, वो जो जिसका ये काम ही है, तो उसको तो मिलता ही है। तो
Sir,
you can
I have app in my mobile. It's Zerodha की एक ऐप है। So उसमें क्या है कि उसमें हम जैसे लोग जैसे जो न्यू हैं उनको अगर ट्रेडिंग का पता नहीं है या स्टॉक मार्केट का ज्यादा पता नहीं है, जैसे हमने तो थोड़ा बहुत सीख भी लिया, पता भी कर लिया है, बट उसमें क्या वो प्लेटफॉर्म के बारे में, हर चीज के बारे में सही से एक डिटेल में बता भी रखा है। तो वो ऐप जो है मैं शेयर कर दूंगा अपूर्व को और बाकी किसी को जिसको भी चाहिए होगा, तो उसमें बहुत हेल्प मिल जाएगी। उसके बाद ट्रेडिंग कर सकते हैं आराम से।
बिल्कुल हाँ, ये कर सकते हो। दिस इज अ गुड थिंग। सो यू कैन आल्सो शेयर इन द ग्रुप मे बी, एंड बिकॉज we can maybe probably have a demo also one point in time, just to see like how it actually normal session, maybe half an hour, to see how things happen there, and it might be for the benefit of everyone in the class, for Neha, Arifa, and all other members of the team. They can also have a feel of how it actually works, and maybe not today, tomorrow you might think of doing it, right? Today you might not be thinking, but tomorrow you might think of doing it, because this is really a good way you can be attached to the financial market. Otherwise, when you don't have anything at stake, or when you do not actually put in your money into it, you will not be attached to the financial thing, because you don't feel like there is something to really go. You're just doing your job, it's going nice and everything is there. But if you actually plan to go for the higher education, everything, right, I will strongly recommend you guys. Why I'll recommend you? because that way you can actually be attached and you will constantly be reading something or the other for sure. Why? Because you know your money is at stake. You would like to be updated so that you can safeguard your money, at the same time you can make money also. So that is how the things work. So you can think of, if you require any of the trading account, or maybe any of the information also, it's not account, information regarding all those things, and probably we can also talk about that stuff. So okay, so that is just for your information. And now we have done with Bissell thing, right? So this slide I will share maybe later on. Okay, let me cross it. Then the next thing, and that is also one of the important regulation that came into existence, and that is about Dodd-Frank. Right. So what is Dodd-Frank, and how it came into existence, and what are the implications of this Dodd-Frank, and is it really being followed right now, and if that is following the complete regulation which was made one point in time in the past, or if it is just being followed partially. So all these things would be discussed in this presentation, right? So this is also very good presentation. Probably we will not be able to cover it completely today. We would just be able to cover few of the slides today. Then there's some other part what we would be doing. It would have Dodd-Frank and the EMI regulations. So we would be covering some part of it today, and the remaining part would be done in the following weekend. On the following weekend, we would be doing the remaining part of it. So if we look at this slide that is right now opened on my system, it talks about Wall Street Frank Dodd-Frank. Dodd-Frank is basically, it is a law that came into existence post 2008 financial crisis. So post, this is the this is one of the control of the measure which was taken by the US government to strengthen their financial system, to bring more controls in it, to ensure same kind of crisis doesn't it doesn't come in future in the US. So that was the overall objective of bringing this law. And if we go through this slide, the first paragraph says Dodd-Frank Wall Street Reform and Consumer Protection Act is a massive piece of financial reform legislation passed during the Obama administration in 2010 as a response to the financial crisis of 2008, named after sponsor Sen Christopher J. Dodd and Representative Barney Frank. The Act contains numerous provisions spelled out over roughly 2,300 pages, and that were to be implemented over a period of several years. Dodd-Frank established a number of new government agencies tasked with overseeing the various components of Act and, by extension, various aspects of financial system. President Donald Trump pledged to repeal Dodd-Frank, and in May 2018 signed a new law rolling back significant portion of it. So in short, we can say the Dodd-Frank, which came into being in 2000 post 2008 crisis, is not same now. Some of the aspects of Dodd-Frank has been repealed, and it has been not fully changed. Some pieces of the law has been amended, has been changed, and some is there. So what all those have been changed, what all those are there, is something that we are going to talk about today. Neha and Arifa, you both are there. Hope you don't have any questions.
Yes,
and
sir.
everything. Okay, fine. Arifa is there? Arifa is there, right?
Yes, sir.
Okay, okay, fair enough. So if you have any question, maybe anyone, please let me know, or either chat on the window, right? If you are on mute, maybe chat on the window, or maybe whatever way you are comfortable with. So let me know if there are any questions, right? Or you can let me pause. I can pause on the slide that we are talking about, so that your questions can be answered if anything comes to your mind. Okay. Okay, so here on this slide 2, this is the key takeaways that we're talking about. Key takeaways: Dodd-Frank Wall Street Reform and Consumer Protection. So the full name is Dodd-Frank Wall Street Reform and Consumer Protection Act, targeted the sectors of financial system that were believed to have caused the 2008 financial crisis, including banks, mortgage lenders, and credit rating agencies. So this law, which came into being after 2008 crisis, so this has lot of things into it, and it targeted to all these stakeholders, which is there, banks, mortgage lenders, credit rating agencies. So they all were under under the scrutiny of this law, or under the scrutiny, you can say, or under the monitoring of this law. Critics of the law argue that the regulatory burdens it imposes could make United States firms less competitive than their foreign counterparts. So this was the there were a lot of the range of people who were advocating this law would really be crippling the US economy, and US would not be competitive compared to their counterparts and the other firms across the globe. So that is how this law was perceived in the beginning, and therefore some part of it was repealed also in 2018 by the Trump regime. In 2018, Congress passed a new law that rolled back some of the Dodd-Frank restrictions. How Dodd-Frank Wall Street Reform and Consumer Protection Act works. Dodd-Frank Wall Street Reform and Consumer Protection Act was intended to prevent another financial crisis like the one in 2008. Dodd-Frank Wall Street and Consumer Protection Act has many components. These are some of its key provisions and how they work. So the first is financial stability. The components, now we're just going to talk about the components and everything. Under Dodd-Frank, the Financial Stability Oversight Council and Orderly Liquidation Authority monitor the financial stability of major financial firms whose failure could have a serious impact, serious negative impact on the US economy. Companies deemed too big to fail. The law also provides for liquidation or restructuring via orderly liquidation fund established to assist the dismantling of financial companies that have been placed in receivership and prevent tax dollars from being used to prop up such funds. So here in this financial stability, which was one of the component of the Dodd-Frank law, two things are important to understand. One is the Financial Stability Oversight Council. So this Oversight Council was formed and this fund was created, Orderly Liquidation Authority. So under the supervision of Orderly Liquidation Authority, one fund was created. And this Financial Stability Oversight Committee or Council was supposed to monitor all the companies which are listed on the exchange, right? That is the Securities Exchange Commission, and they need to monitor them on a regular basis to see if these firms are not going through any distress or any hardship, and especially the ones who are considered to be too big to fail. Especially the ones which were considered to be too big to fail. So with this Financial Stability Oversight Council, it was the objective or the aim was to ensure the companies which are listed on the exchange and considered to be too big to fail are monitored regularly to see how they are, if they are capable enough to manage their business properly going forward or not. And if there is anything which is found to be unusual, if there is anything which is found to be unusual in terms of the problems which the companies face, then this orderly liquidation authority would monitor the liquidation problems and accordingly fund them with the money which is under their supervision, with the approval approval of the Financial Stability Oversight Council and the government of the day as well. So this was the overall thing with the financial stability. Okay. The council has the authority to break up the banks that are considered to so large and pose risk. One second, it is hidden. One second, it is not. Okay, so there it can, the council has authority to break up the banks that are considered so large, so to pose systemic risk. It can force them to increase their reserve requirement. Similarly, the new Federal Insurance Office was tasked with identifying, monitoring the insurance companies considered too big to fail. So if you look at here, so the objective was to see which all companies which are considered to be too big to fail, if they are functioning well or if they have more risk attached to them. So if in case there is some changes need to be done, so this Financial Stability Council has the authority to break them up, right? To break them up, to provide the liquidity if they thought so. So there was a Federal Insurance Office under the Financial Stability Council, right? Under the Financial Stability Oversight Council. So they were supposed to monitor Federal Insurance Office as well, to identify and monitoring insurance company. So they were supposed to, this particular office which was set up under the Financial Oversight Council, right? So this office was supposed to oversee the activities of the insurance company, especially the one which were too big to fail, like AIG. There was this question raised many times. The AIG did not do its job properly during these times, 2001 to 2008, and therefore they were also not compliant to various laws, and therefore this crisis whole erupted and came into being, rather. Right, so this is financial stability. So these are the components, you can say. These are the component that we're talking about of Dodd-Frank. So what all component, in a sense, the committees, you can say, which were formed, or the desk which were made by the government to ensure the various markets or various particular various, you can say, the arms of the financial market, like the insurance one, the Securities and Exchange Commission, in a sense, the first one, the companies where the companies were listed. So they will regularly monitor the companies which are there on the exchange and see if they are functioning well, if is there any company which is not able to function due to any reason, or if they would also help them carry out stress testing, do this stress testing, see how they actually come out in the distress scenario. So if they are able to manage the risk factor, or they are capable enough to take care of the risk in this short span of time, 30 days time, right? So that is how all these things were placed in this financial stability thing, and the idea was to ensure this company, especially which are considered to be too big to fail, are they really capable enough to manage their risk and everything on a regular basis or not. So it shouldn't be they are just carrying out their duties, they're carrying out jobs, one fine day all of a sudden things go haywire and companies are not able to function at all. So that shouldn't be the case. So objective, this was the objective and aim of this Financial Stability Council to oversee. Similarly, they also made one Federal Insurance Office. So insurance office was to identify the insurance company and to look at their insurance practices which they were following, to ensure they are following the right practices, they have the right way of providing insurance and everything. Okay, moving on to another component of uh, this law, that is the Consumer Financial Protection Bureau. Consumer Financial Protection Bureau, established under Dodd-Frank, was given the job of preventing the predatory mortgage lending, reflecting the widespread sentiment the subprime mortgage market was the underlying cause of 2008 catastrophe, and make it easier for consumer to understand the terms of a mortgage before agreeing to them, and it deters mortgage broker from earning higher commission through closing loans with the higher fees and higher interest rates, and requires the mortgage originators not steer potential buyers to do loans that will result in the highest payment for the originator. CFPB also governs other types of consumer lending, including credit, debit, and address consumer complaints. It requires lenders, excluding automobile lenders, to disclose information in a form that is easy for consumer to read and understand. The example in this example, an example is the simplified terms now on the credit card application. So with this, we can really understand like what actually this bureau was meant to do, what was the objective of bringing this bureau under the Dodd-Frank law. So objective was to, because we know how this crisis actually came into being. This came into being due to the subprime mortgage given to the consumers in the USA, right? So had it not been done that way, probably there wouldn't been a crisis of 2008 in the USA. So that is how a lot of emphasis and lot of stress was put into putting on the lending thing, how the lending was being done, or how the lending should be done going forward. So there were some criteria which were specified by the bureau, and so they completely made it strict for all these companies that they need to follow certain golden rules before lending money to the lenders. So they cannot go without going through the credit history of the borrower, and at the same time the borrower should be very well versed with the credit conditions and credit obligations which they're gonna bear, they gonna have over the duration, over the tenure of the loan. Because there were borrower at one point in time before this 2008 crisis, in the subprime crisis time, the borrower were taking loan, but they were not even aware about the terms of the loan. They were taking a loan because there were many borrowers for their credit rating were not that strong, and they were quite happy with the fact they were even given loan. So that was the case in 2000, before 2008 crisis, during this subprime crisis, right? So these factors were duly considered while this bureau was made under the Dodd-Frank law. Like every loan which is granted to the consumer in the US market, it should be very well checked, due diligence is performed, and then the loan should be loaned out to the consumer. At the same time, consumers should be made aware about all the terms and conditions of the loan. Consumers should be reading them through properly. They should be giving their sign off. They should be ready with the terms and condition, and there should not be any predatory lending. Predatory mortgage lending reflects that basically means you are actually doing you're following the wrong practice of lending. You should not be taking any wrong practice of lending, and the interest rate, fees, everything should be disclosed properly to the borrower. Similarly, it was just not limited to the home loan thing, it was also extended to the other kind of loan like credit card, other type of loans. It was also extended. So this is Consumer Financial Protection Bureau's role, which came under Dodd-Frank rule. Then what is Volcker rule? Maybe with this we will bind it up today, and then the other slides we will be talking in the next class. So this is the last thing that we will be doing today. So Volcker rule is basically talking about how a bank should be using the money of the customer. So there was one question raised by many people why the bank is allowed to use the money of customers for its own purpose. That is called proprietary trading. Proprietary trading is one of the word which is very widely used in the banking sector, wherein the bank is allowed to use the money of the customers. So with this Volcker rule, it was made strict, and it was made a rule. Bank would not be allowed to use the money of its customer. So bank are not supposed to touch the money of customer, which is in the deposits, in the form of deposits, or in the form of savings and all other things. Bank can never use it for the speculative purpose in trading and everything. So if you look at this statement or the words which are written there, another key component of Dodd-Frank, the Volcker rule restricts the ways bank invest, limiting the speculative trading and eliminating the proprietary trading. Banks are not allowed to be involved with the hedge funds or private equity funds, which are considered to be risky. In an effort to minimize the possible conflicts of interest, the financial firms are not allowed to trade proprietary without sufficient skin in the game. The Volcker rule is clearly a push in the direction of Glass-Steagall Act of 1933, which first recognized the inherent dangers of financial entities extending commercial investment banking service at the same time. So with this, if you look at this complete thing, so already there was a law in 1933 that is to ensure the customer's money is segregated from the investment banking, which the investment bankers are doing, right? So this law which was there in 1993, it was repealed in 1999. In 1999, this law was repealed. So it was felt after 2008 crisis, this is very much necessary that customers' money and the and investment bank, they should be not merged together. So investment bank should function in a separate manner, and the deposits and everything should never overlap with investment bank, should not be overlap with these two banks. So that is how this thing came into picture. The Volcker rule is basically safeguarding the interest of the consumers who are putting their money into in the form of deposit with the bank, so that those money is not used for any speculative trading by the investment banking arm of the bank. So in the form of the proprietary trading which they are doing. So proprietary trading is allowed. It is not the bank is not allowed, but they should be using proprietary trading with their own money, not with the help of the customer's money. And at the same time, they were not allowed to involve with the hedge fund or private equity firm with the money which they were having from the customer side. So they can go and do the hedge funding and private equity funds with their own money, but not with the money of the customers. They're not supposed to touch the customer's money. So that is what the Volcker rule actually talked about in Dodd-Frank. So with this, I'll conclude here. I'll close here. Any questions, guys? Anything that is in your mind? Maybe you want to discuss, you want to talk before we wrap it up?
No, so nothing specific.
Okay, so guys, so fine. So this we will be continuing with the same slide in the next class also, because it will require one or two classes, because there are just a couple of slides here, and then we would be talking about post this. We will be doing another thing. So I assume there is no question, guys. Any question? Neha, Arifa, Ajay, anything from your side, maybe?
No, sir.
No, sir.
Not now, sir.
Okay, no problems. Okay, so I'm just closing for today, and on the next weekend we will be doing the remaining slide which we could not do today. Okay.
Yeah, sure. Sir, you please share the slides also.
Yeah, I'll share the slides also. Sure, I'll share. Okay, guys. Bye bye.
Okay,
See you.
see you.
Take care.
Okay, sir. Bye bye.
Bye bye.